What is a currency and how does it affect commodities? Imagine a situation where countries start competing by making their currencies weaker. This is known as a currency war, and it can shake up the entire world of commodities. Countries do this to make their exports cheaper and more attractive to buyers abroad. They hope to boost their own economies, especially during tough times. But when one country weakens its currency, others often follow suit, creating a cycle of competitive devaluations. This can lead to big changes in how commodities are priced and traded globally. Most commodities like oil, gold, and wheat are priced in major currencies, especially the US dollar. When a country devalues its currency, the cost of commodities in that currency can change a lot. For example, if the US dollar weakens because of a currency war, commodities priced in dollars become cheaper for people holding other currencies. This can increase demand and push prices higher. On the flip side, if the dollar gets stronger, commodity prices tend to fall because they become more expensive for buyers using other currencies. Currency devaluations also make imports more costly. If a country's currency drops in value, importing raw materials or energy becomes more expensive. This can lead to higher costs for producers and possibly cause inflation. When inflation rises, the prices of commodities can also go up because producers need to cover their increased costs. This can affect everything from food to metals, changing the landscape for investors and traders. Currency wars can cause disruptions in trade flows. Countries might manipulate their currencies to gain an advantage, which can distort normal trade patterns. This creates uncertainty for companies involved in commodity production and distribution. They might face higher costs for hedging currency risks or experience unpredictable supply chain issues. Such volatility can make investing in commodities riskier but also open up opportunities for quick gains if you understand how currency movements are influencing prices. Another impact is on global economic growth. When many countries engage in currency devaluations, it can lead to a slowdown in international trade. Reduced trade means less demand for commodities, which can cause prices to fall over time. Historically, during the 1930s, widespread currency devaluations contributed to a decline in global trade and commodity consumption. For investors in commodities, understanding currency wars is key. These wars can cause sudden price swings and increase market volatility. Keeping an eye on currency policies and exchange rate movements helps in making smarter investment decisions. When currencies fluctuate wildly, commodity prices often follow suit, so being aware of these shifts can help protect or grow your investments. In essence, currency wars influence commodities by changing exchange rates, which directly affect prices, costs, trade flows, and investment risks. Recognizing these patterns allows investors to anticipate market moves and adjust their strategies accordingly.